captioning is brought to you in part by Bell. Switch to amazing Bell TV. One phone call and get set up as early as tomorrow. Bell. Switching just got better.
David Burrows is our guest from Barometer Capital, and Urbinder joins us from Markham, Ontario. Hello.
Hello, sir. Thanks for taking my call.
Thank you.
Yes, David. What are the long-term prospects for the Tim Horton? Because first I bought for 53.70, then on Friday again I bought for 50.80, and today the price has gone down. Why the prices are going down? Because the profits are rising, sales are good, and why the prices are good? And my second part of this question is there any chance of dividend increase in the future? Thanks.
Okay. So I'll answer the second question first. Tim Hortons has been wonderful at growing the dividend. They've grown at roughly 15% a year over the last 5 years, which is one of the best growth rates. It's not the biggest dividend around, but it's growing very quickly, and we like that. The negative on Tim Hortons is the same difficulty as McDonald's. It's the same difficulty as Starbucks. There's a slowing in transaction growth, and as a result, share price is backing off. So there is a big question mark around the consumer right now, and I think that you have to be a little bit careful in that consumer-driven space.
They're offering those single-serve Tassimo cups for home, as well as still looking for a new CEO. Are these catalysts for growth or concern?
Well, they certainly could be a catalyst for growth, and they're doing a good job in the U.S. market. You know, there's lots of things to like about Tim Hortons. The problem is they are a little bit tarred with the same brush as the rest of the sort of high-volume convenience market.
So Urbinder's seen his stock price decline from his initial purchase price. Do you see a floor on the shares at any point? It looks like it had a good base over the Christmas holidays around the $48 mark.
Yeah, it's being hit by two things. You know, with the prospect of central bank easing, there is some money rotating to what they call risk assets, and they're taking money out of sectors that have been strong for a period of time. The problem is that this is probably compounded by the fact that there has been a slowdown with the consumer in the quick service restaurants. So those two things probably in the short run put a little bit of a lid on the stock.
Urbinder, thanks for your call. Time now for the Market Call Minute. All right, for Tony in Calgary, Pembina Pipeline, buy, sell, or hold, and do you own it?
Buy the stock. We would be comfortable owning that sector and that company specifically.
Do you own it?
We do own some.
For Gordon in Ottawa, Manulife Financial, buy, sell, or hold?
I would still sell the stock. With very low long-term interest rates, hard for them to generate earnings on their investment portfolio, and with volatile equity markets makes it tough as well.
You don't own it, you're not shorting it?
We are short the stock.
You are short the stock. Jack in Bath, Ontario, Hewlett-Packard, HBQ, is it a BUY?
One of the weaker names in technology. Certainly has had a rally with many of the stocks that discounted weakness. Too early to buy the stock.
For Michelle in London, Encana, as we talked a little bit earlier, you prefer that one?
You could buy some Encana and look at averaging it on the way up.
Do you own it?
We do not own the stock.
Patrick in Montreal, Baytex Energy, BTE on the TSX.
We like the yield-generating oil companies. This one is probably a little bit too early. I'd like to see the stock in the high 40s before I would enter.
So you do not own it?
No.
All right. Thank you for your telephone calls, your email messages as well. When we come back, it's the top picks from David Burrows, president of Barometer Capital Management.
Before we got double miles with a